Today we have three very special guests joining us, all from the Prospector team. Jonathan Godbout is Prospector's COO and a fellow proud Mainer. John leads all new product design and engineering at Prospector, which requires him to know our data inside and out. Gautam Iyer is our head of data, coming to Prospector with extensive experience in corporate development and strategy within the junior mining industry, as well as an MBA and master's in geoscience. Gautam has become our team explainer, helping our team members who are new to the industry understand its ins and outs and unique terminology. LePan is our head of content, and he brings a decade of experience working in financial and mining media as an editor, writer, and sales professional. Nick is also the author of Prospector's weekly email newsletter, The Nugget, which you should have all subscribed to, and you can also keep an eye out for his upcoming 2021 Year in Review report, which will be coming out soon. Let's dive in. All right. Well, John, Gautam, and Nick, thank you so much for joining me on The Rocks. It's a Prospector team podcast today. Welcome, everybody.
Hey, everyone. Glad to be here.
Hello. Welcome.
Hey, everyone.
What are you all drinking technically during the workday while you are still working for Prospector?
Copious amounts of coffee.
I'm just having a bubbly, 0 calories.
Beau's Lug Tread, a great Toronto beer. If anyone at that organization is listening to this podcast, feel free to send me some.
Yeah, we'll make sure to hashtag and tag them in all of the posts. Absolutely. Well, I am obviously leading the charge on the alcohol content here. I'm drinking Widow Jane. A friend of mine just gave me a bottle of this, 10-year, and it is made out of pure limestone mineral water from the Rosendale mines of New York. So appropriately mining themed, which I thought was pretty cool. Again, we don't really oftentimes hear about mining in New York, even historical. So water out of the Rosendale mines is clean enough to turn into bourbon. That's what I take out of that.
Well, it's technically not bourbon.
No, it does say it's a blend of straight bourbons.
Really? Because it doesn't have to be from northern Kentucky?
I think they used to, but I don't think they've gone full France, like with the cheese rules or whole Europe with all the restrictions.
I see.
So Widow Jane, reach out similarly to, sponsor the podcast and clarify whether you're allowed to call it a bourbon. We'd like to know. Inquiring minds want to know. This will be a fun podcast because as a team at Prospector, we've been talking about all the data we've been pulling in from many, many companies, wonderfully written, very transparent and easy to understand public disclosure documents over the last year. Nick, as our head of content, you've been working on a 2021 Year in Review report that we'll be putting out shortly, but we thought it would be fun to come on and give the listeners a little bit of a sneak peek as to what we've seen over the last year, and looking back, maybe some themes and trends, and talk a little bit what we're seeing and why it's important, both for folks inside the industry and also folks that are really just starting to get educated about it. So why don't we start with everyone's favorite topic, which is gold price. Everybody seems to be well informed about gold, where the price is and where it's headed. So Nick, why don't you tell us a little bit about what we saw in 2021 with the gold price?
So gold, pretty much in the beginning of the first part of the year, it started off very strong. The beginning of January, just around 1950, but it went on a pretty good drop for the up until about March, where it hit a low of about 1670, but then it rallied back by June to around a high of 1900. But ever since then, we've just kind of been hanging around 1800, maybe up to 1850, and it's been pretty relatively stable. But the good news is that the year before we had such a great year in gold that, we raised, according to at least Mining Intelligence, is that about $2.87 billion was raised for 425 transactions for gold projects in 41 countries. So a lot of money that was raised in 2020 went into work for 2021. And from our review, we came up with about, at least just on the gold side, about 200 plus technical reports that were filed this year, just based off of kind of work that was being done, anything from, maiden resource to an update to a PEA. So there was a lot that kind of we went through. Yeah, so it was a good year for gold. It was relatively stable. A bit worried in the first half, but second half turned out to be a little bit more safe.
That's a great summary. And Gautam, as our head of data, what does that tell us about what's going on? Why is that important for folks to understand?
Gold impacts the bottom line for many of our producers, right? And so keeping an eye on the gold price is just, it's monumental, especially as an investor, right? You want to make sure that companies are profitable. And a lot of companies, when the gold price goes down, they're not profitable anymore because their costs are, more than their revenues. So, I mean, gold price is the fundamental aspect, and unfortunately, we can't control that. Nobody controls that as a corporate entity. It's just one of those things that we need to ride. And as long as it's high, we're all happy. We all celebrate. Times when gold prices are low, like we all suffer together. Any gold analyst would tell you that we cannot predict the gold price of the future, right? We have a general sense of where it may go. But in terms of actually predicting gold price, that's impossible because there's a lot of sentimental value associated with gold. One thing for certain is gold has stood the test of time, so to speak. It's been a very safe haven for a lot of investors. Gold is a very safe investment. I mean, obviously, I'm not an investment advisor. I should make that disclaimer for any of the listeners here. But it's always fun discussing many different cultures. Gold is a pretty big gift item, not just during marriage, but also celebrations, right? In India, for example, during the festival times, gold is one of the most dominant gifts. Same thing when you're looking at China during celebratory festival times, during the New Year, gold again is very, very prominent. And so there is a demand aspect to it as well.
Like if we think of all the gold mining companies as an index, right? That index is not performing the same as the price of gold. It's it's oftentimes well undervalued, and I think that I very rarely hear a mining company talk to us and say, "Oh, we're trying to get something on another mining company and compete." It's almost to the fact of we hear a lot of this as an industry. There needs to be more investment, and we need to our collective success works when everyone else is. It's not like if I get X dollars investment, someone else is not going to get it. It seems to be a fact of everyone needs more investment in the sector because otherwise things are going. And we pull out data like the life of mine plans when we're trying to look at what's the net present value of the assets and how does that compare to the overall company's price. And we're seeing a lot of companies undervalued. I think that's the key here is how do we increase investment to the sector? I think it's really difficult for a lot of people to kind of understand what happens. But at the end of the day, I don't come from the mining sector, and if I can understand what a mineral resource is, I think almost anyone can. And I think that, that's a big part of what we try to do as a company.
Well, what we've seen is, all that money that was kind of raised in 2020 kind of actually went to go towards defining some pretty large resources. I've been kind of watching this sector for a while, and money going into the gold explorers is typically kind of a bit of a leading indicator. They help open up other regions, and one of the biggest regions that's kind of been opening up, at least from our survey, is the Golden Triangle area of British Columbia. Tudor Gold and its Treaty Creek property in the heart of the Golden Triangle, which is just, it's on trend with Seabridge Gold's KSM, but they put out a massive resource that was about 25 or 24.5 million ounces, albeit at kind of a lower grade, but by far that was the largest resource of the year. But again, there was also a lot of projects that were just kind of upgrading resources or kind of adding to already known resources. So they would put out a maiden resource on a kind of an additional deposit. So again, this is the second largest. That was the story for Sabina Gold and Silver. They added a couple million ounces, but they're sitting at a total of about 9 million ounces of gold up in Nunavut as well. They already had a report, but they did enough exploration, about 56,000 meters of drilling. They were probably funded well to get that done and able to add ounces. But as you can see, it's a big drop from 25 million ounces of gold down to 9 million. And then from there, it just goes down to about the next third one is Montage Gold, which is with the Kone project, and it has about 4.5 million ounces. And everything underneath that is in the range to about 1 million, all the way down to about, someone found 95,000 ounces as well. So typically it's the first time kind of like a defined kind of economic deposit of metals is kind of published based off of kind of previous drilling and exploration and geophysical work. It's the first time kind of something's kind of been roughly kind of given a shape and a definition. At the end of the day, these are still estimates ultimately, and like there's a couple categories within the estimation of it that kind of improve the confidence of what's known there. But it's the first time. It's a very important event because everyone loves the drill hole story, like, wow, that's a great drill hole, but what does that mean in the greater picture of it? Is this going to be? What type of deposit how is this going to be mined? Where's the rest of it? Is this economic? And so the maiden resource, it's important because it triggers a lot of stuff, but it's also the first time you can kind of, get a little bit of a snapshot. I'm sure Gautam has a bit more kind of what might be a maiden resource from his experience.
Yeah, absolutely. A maiden resource essentially is another data point that proves a company's thesis, right? At the end of the day, an exploration company should have some sort of thesis about the property that they have, and there must be a reason why they're drilling. The maiden resource essentially proves that, the drilling, all the capital raising that we've done so far to date has been worth it because we have made a discovery. But now, obviously, we have to also keep in mind in terms of what the company or what any company is promising before they have a maiden resource, right? Because you don't want to be in a situation where a company has overpromised and they've still got a maiden resource, but it's just not what they expected, right? That's the other side of it.
I think about some of these companies that are seeing huge valuations, not even on maiden resources, but on drill results. And the whole concept of a smeared drill result is something that's very intriguing, and it's something that I think is important for folks to know. Maybe you can talk a little bit about what a smear result means.
Sure. I mean, to put it simply, you basically average out a very small part of a large drill intercept. Let's say you find 10 grams of gold over 1 meter interval. You're marketing that as if you have 1 gram of gold per ton over 10 meters, right? You're trying to make it seem as if it's longer than it really is. And, with a little bit of digging, it's easy to kind of unsmear these results and see what you really have. Now, obviously, 10 grams per ton of gold over 1 meter is pretty damn good. It's still pretty good. But, there are more extreme cases where grade smearing really, really impacts, the results of a company. Let's say a company does not have a maiden resource just yet, and they're going out, they're raising money, they want to drill, right? The biggest thing that I look for is, where is the asset? Where is the project located, right? How risky is the jurisdiction where the project is located? How easily can you get permits to drill? Because anywhere in the world where you want to drill, do any sort of exploration, you're going to need permits. You're going to need the approval. You're going to need social license to operate. The other thing would be management. What is the experience of the CEO? What's the experience of the geologist, the vice president of exploration, or whoever is running the exploration department? What's their pedigree? Do they come from a track record of discoveries? What have they discovered in the past? Are they more likely or less likely to succeed? Obviously, in a patch of grass, if you're looking at such an early stage project, it's tough to gain an understanding of what success rate would be, but not so much if you see that there are neighboring projects that have been successful, neighboring projects where you have multi-million ounce deposits. So the location, the closeology to other deposits, is it on trend with some sort of some unit of geological significance where there is a higher chance of hitting gold? The other thing that you want to look at is the CEO. You want to see how well the CEO is able to raise capital. Because at the end of the day, when you're investing in junior mining, you're not investing in a company that's going to be making money. You're not going to be investing in a company that's going to be making money. You're going to be investing in a company that continuously will be burning investor money. It will be burning cash on drilling. And in some occasions, you really want to see where the cash is going as well, right? Obviously, management needs to be compensated, but how much of the cash that's being raised is going into the ground, whether it's drilling or geophysics or be what may. So these are some of the important factors that you have to keep in mind. The other thing is, when you're looking at junior companies and you're looking at its relation to the gold price, when the gold price shoots up, it's not often where you see a direct correlation that the junior companies also re-rate immediately along with the gold price increase. This is more prevalent with producing companies because their bottom line is directly impacted. And so there won't be much of a lag, if the gold price shoots up from $1,800 to $2,000 per ounce for producers. For juniors, there will be somewhat of a lag. You're not going to see a junior company re-rate as quickly as producing companies. So the bottom line is discovery. Sometimes it could be a maiden resource, but most often it's, are you hitting gold in the ground? The moment you intersect gold within the ground, that could be considered a discovery. If it's, copious amounts of gold, and by copious amounts, that always varies, right? If your target is an underground target or if your target's an open pit target, it all depends.
Well, there's been some great drill results this year, but it's a bit of mystery. So for example, there's a couple of great copper discoveries this year. I know it's not necessarily related to gold, but they're typically associated with either a gold component in it. But there's a couple of projects in Argentina where they're drilling up to 1 kilometer worth of mineralization. I don't even know how to value that at this point, or, what does that mean? Wow, that's an amazing drill result. That is a discovery itself, but where do you even invest? The stock just goes up, and as an investor, you're just left with X amount of meters, X amount of grams per ton, and you really don't know where to pick up the story. You're just anything could happen at that point. So just from the data, it's just, at least from my perspective, is at least the resource estimate kind of just puts that amorphous kind of bubble around those drill results and shows what it means. But before that, that's what drives the junior exploration business, is that bit of mystery, that excitement that we're onto something.
The treasure hunting.
The treasure hunting, and those drill holes stories are stuff of legend. So it's kind of the fun stuff, and sometimes great drill results do actually turn out into great projects, but more often than not, they're just drill results. And that's where a junior company can redeem itself. If they have a series of okay results, it might actually turn into a actual resource.
No. And that's why, John, I know we've talked internally a lot about, similar to a lot of other data sets we've looked at, how do you make sense of drill results, right? How do you get them all in one place and kind of rationalized or standardized to where an investor or a company can really start to understand what all of that data means collectively and allow for benchmarking, right? I mean, that's something we're looking ahead to for 2022, is better understanding drill result data and how to help investors understand it and access it.
Whether it's a drill result, whether it's a PEA or just a resource, or it's just a resource estimate, I think context matters, right? And the context of location, the context of how you're going to get the metal out of the ground and process it, right? So there's been a couple projects, this year with resource estimates that have come out, main resources, where, they're fairly high grade, right? If it was an open pit, so 2 grams per ton or so, 2 to 3, but they're, underground resource estimates, right? And so, but if you don't know that, right, you know that this is for an underground estimate where there's going to be a high capital expenditure to bring that mine to life, that could be deceiving, to you as an investor. So you got to make sure you know those things and understand the difference. If something's in, northern Norway or Finland and it's 2 grams per ton and it needs an underground mine, okay, well, it's going to be really hard to get a lot of stuff up there. It's going to need a lot of capital. But if you're in West Africa and it's 1.5 grams per ton, it's open pit, that's a whole different story, right? Because it's there's different cost of capital and labor, and it's the mine plan's going to look different. And you got to understand the context of those things, because while the drill result is informative, it's all the other pieces that go around it that are going to tell you the overall value of that asset long term. I think about the announcement in December about Great Bear. There wasn't a lot of detail going into that. It's kind of intriguing, right? You're seeing a lot of companies maybe holding some details closer until the time comes, right, and they're ready for something.
Yeah, I mean the Great Bear acquisition by Kinross, which I don't think it's closed yet. There's a specific detail within that transaction where I believe the Great Bear shareholders get a bit of a kicker if Kinross is able to delineate, I think, 8.5 million ounces of gold right? And so any caveat that's like that makes me feel like they know exactly what they're acquiring, right? They know they've done their due diligence. They know exactly what's in the ground. And Great Bear, it's a great story because it's they don't have a delineated resource. They didn't have one when they got acquired. And their shareholders, the Great Bear shareholders, pre-acquisition, they received a lot of wonderful drill results, right? Which is what their valuation was based on. And so I think the deal value was approximately 1.44 billion. And when you're looking at it on a dollar per ounce basis, assuming the 8.5 million ounces being delineated, that's about $160 an ounce. I mean, it's a great acquisition for a Great Bear.
Well, yeah, as Gautam pointed out that, the Great Bear was kind of one that was anticipated, a lot watched. They'd had about 2-3 years worth of drilling, and, it really is kind of a great discovery story. It was an asset that had previously been explored, but didn't quite get kind of discovered. So that's a great story. That's one of the more kind of famous stories. But of course, there's Agnico Eagle's offer to take over Kirkland Lake. That deal was valued at approximately about $10.5 billion, and that valued each. And the ounces acquired were about 39.5 million ounces. So for the top 10 deals, Gautam put this research together, is that, about 105 million ounces of gold switched hands in 2021. And the total kind of deal value of these top 10 was about 17.5 billion. And on average, these companies were buying their gold ounces for about $166 per ounce. So that's a big discount.
It's also important to remember that these ounces, they are global resources, right? So when we're talking about maiden resources or any resources, we have those categories of confidence, right? We're looking at inferred resources, measured and indicated resources, and reserves, which are the highest confidence. So this is all of that put together, on a per ounce basis. And so obviously the lower confidence ounces would be had at a much higher discount than the higher confidence reserves.
Well, yeah, there was a couple of, Fortuna Silver bought Rox Gold, and on that deal valuation of a per ounce basis was around $367 per gold ounce. So that was relatively one of the more expensive deals of the year. But then you also had fire sale assets, stuff that was just kind of literally distressed. Nobody wants it, but somebody's got to take it. Well, there's Agnico Eagle's buy of TMAC Resources Hope Bay project up in Nunavut. They bought that project for approximately $30 an ounce.
When we look at production metrics, the things we capture and things we're looking to roll out in the new year, we look at overall production by ounce, overall sales. But it's always important to remember is looking at the cost to produce those ounces and to sell those ounces. When you look at, a pretty common metric is the all-in sustaining cost and cash cost per ounce. It's not standard across companies, but it is a pretty good metric to tell you, if this company is producing 10,000 ounces and the price is $1,800 and it's going to cost them $1,200 to produce it, well, that's $600 worth of profit per ounce. Now, that's a very rough approximation, right? But those are the kind of things to think about when you're looking, because if something is in a very remote place, they may have a high cost per ounce. Typically we see lower cost in places like West Africa, where the open pit cost, and higher cost in more remote places where you have maybe an underground mine.
If you don't know what it is that you're trying to look for, it can be hard if you don't have a platform like Prospector or other tools to look for it, but it is all public, right? And these aren't interpretations necessarily of what a company is telling us. These are what the numbers tell us that the companies are giving us.
That's the thing is all this information is publicly available, but it's a lot. It's a lot of information, and you need people that kind of have that insights to kind of be able to kind of organize the information, what makes sense and all that. It is public, and you can do the work to kind of do it, but it's a lot of work, and like there's different language barriers. There's like people word things differently within there, and so the information is just like it's technically all there, but is it really all there? Like it's
oftentimes a company will own a property. They will have optioned it out to another company who's in charge of doing a lot of the work to get to a resource estimate, right? And when the two of those companies are disclosing those activities, they don't always make it very easy to understand the option arrangements. You may not know how much a company owns of a particular resource. it does require a good eye. And I can tell you, having gone through, I think 1,800 companies at this point, it's it's quite challenging. So typically, an earn-in option is something where company A has a property, right? They may not have the capital to do the work that requires to do all the drilling to get to a resource estimate, and they may offer company B some terms by which they can get an ownership in that property, provided they meet certain milestones. That could be cash payments. It could be. So it's a very popular mechanism with juniors, right? Because particularly when the junior doesn't have a lot of capital, they may go buy some pieces of land, option it out to get some capital, maybe use that capital for other things or for that resource itself. And then what that does over time is it changes the ownership, right? It could go from you own 100% down to 60% in a year, depending on what those milestones look like. You got to pay attention to that when results come out, because if 2 million ounces come out and the company's optioned it, there could be differences in the amount of ounces that company's entitled to.
And another thing to add would be it allows companies to somewhat de-risk an acquisition, because it allows them to stage their payments after certain milestones, right? So let's say there's a junior company that options out a project where they feel there might be gold. They can walk away from that project, depending on the agreement, at any stage if they feel like, you know what, there probably isn't anything here. We just need to walk away instead of following through with the entire option payment. That's just a very good way to de-risk for their investors as well, right? Cash is everything. Capital is everything when you're in the junior market. And so it allows you to kind of pick and choose whether or not you want to keep continuing with a certain project. I mean, you just need to know that the project is not owned 100% by the company you've invested in, right? There's a clear pathway to earning that 100% ownership, but just at any given time, if they have not fulfilled all their obligations, they just don't own the project, right? A lot of times, the company that options out the specific project would have caveats as well. You know, for example, if they discover X amount of ounces, that company that has optioned the project to the other company would get some sort of bonus, for example, right? So there are a lot of different factors in play. I don't think investors need to worry too much about, you know, a company is bad or a company is good because they've optioned project. It's just, you know, be aware that the project your company states on their website may not be owned by that very company. It might just be a project that's been optioned.
You know, a lot of times in those agreements too, what will happen is they convert over to a royalty arrangement, right? So if company A owns the property and they're optioned to company B, once company B gets the entirety of the interest, company A would retain a royalty on a portion of the sales of the gold.
Royalty companies have been a great way to kind of at least attract money into the industry over the past couple of years. They've been the more preferred way of kind of like financing these operations that, you know, shareholders seem to like it. The markets seem to like them. It's been a very successful model. That was one of the trends this year. There's been a couple of royalty companies that kind of launched in 2020 and then really got their legs over the past year. You know, it's a great way to kind of finance a project, and it's a lot better than kind of investing directly into an asset. You kind of have this portfolio of projects that you can kind of pick and choose. And I think it was Pierre Lassonde that kind of did the first one. So he set the mark for it. And so it's a great model. It's a great model. And I know some guys kind of grumble about it and, no, not another royalty company. But it's a great way to, you know, finance the business, because it takes years sometimes to kind of get something in production, and people like that structure. So
it shields you directly from a lot of those, like the direct operational risks that you face when investing in an actual mining company.
All right. If you could wave your magic wand and change one thing about the mining industry, what would it be?
It would be to just make it more sustainable, more environmentally friendly, and more inclusive. And I'm not just saying inclusive in terms of like the workforce, but just inclusive of communities.
Just come from my background, I always think about exploration companies and just kind of the patches of land that they have. Like my dream is if they could come up with some type of side business or alternative business, either carbon credits or do some lumber milling on their property for that 2-3 year period while they're doing it, like some type of revenue to come in. Like that's what I do, is if there was some way to kind of also use that land, or if they could come up with other ways to generate revenue during the process with that patch of land, because these guys hold, areas the size of small countries. And anyways, if there's something they could do with that, that's what I would change.
I think about a lot of my friends that live on the continent. When I say the continent, I mean the African continent. And I think about investment, and I think about the mining sector, right? We talked a lot about how there's a lack of investment if we look at across the board for gold companies and mining companies in general globally. Obviously there are the perception issues, but I think it's just accessibility of investment as well. We have a lot of staff that work for us in East Africa, South Asia, right? We're a globally dispersed team. And the only mechanism that's available for those individuals to invest in at the moment is really Bitcoin, like digital currencies, right? They don't have Robinhood. And to me, it's how can we change how investment flows into the industry? Because I feel like those are latent places with lots of capital that are really willing and ready to invest, but it's not easy. These aren't people that are going to place $500,000 in a company. They're people that maybe have a couple $1,000s, but there's a lot of them, right? That can place those funds. And how does the industry look at that as a way to drive investment? Because I do think there's an opportunity there. And maybe it's through royalty arrangements. I don't know what it is, right? But if we could do pay for flow with Robinhood and digital currencies, why can't we do it with mining investments?
Well, thank you guys. I mean, again, I talk to you all pretty much every day, but it's really fun to have you on, and I look forward to touching base with the team and sharing with our listeners kind of what we're seeing as we move into 2022, what we see looking back towards 2021, and kind of what we think is coming up next. And absolutely, for everybody listening in, keep your eyes out for that report coming out from Nick and the team, looking back at 2021, and keep your eyes out for new tools and products coming out from Prospector that we hope will address some of the things we raised today. Thank you to all of my guests and colleagues for joining us on this episode of On the Rocks. To learn more about Prospector, go to our website at prospectorportal.com and subscribe to our weekly newsletter, The Nugget. Thanks for joining us on The Rocks. If you enjoyed the episode, click the subscribe button and please leave a review. Until next time, keep your glasses full and your ice cold. Cheers.